If a position is up and you sell for a small gain, did you manage risk well? Or did you interrupt a good process just to feel right? That question matters because small wins are emotionally powerful. A gain, even a modest one, can create a sense of relief, control, and competence. In investing and trading psychology, that emotional reward can become a hidden influence. The problem is not that selling after a gain is always wrong. The problem is that the feeling of being correct can start driving decisions more than the plan that was supposed to guide them. This is where a disciplined process can get disrupted. A process is the set of rules or reasoning you use before emotions show up. Why you entered, what would change your mind, how much risk you plan to take, how large the position should be, and under what conditions you would reduce or exit. If that process has been thought through in advance, then a small gain should not automatically become a reason to act. But in real time, it often does. The key idea is that three actions can look the same on the surface, but be very different underneath. First, you might exit because your original thesis changed. A thesis is simply your core reason for owning the investment. Maybe the business conditions you expected no longer seem likely, or the setup you were waiting for is no longer there. In that case, selling is not about locking in a nice feeling. It is about admitting that the original case is weaker or invalid. Second, you might trim because predefined risk rules called for it. Trimming means reducing part of the position rather than selling all of it. Some investors do this when a position becomes too large relative to the rest of the portfolio, or when their allocation rules require rebalancing. Rebalancing means bringing positions back toward planned weights. Here, the sale is process-based. The gain may be present, but it is not the true reason. Third, you might sell mainly to lock in satisfaction after being up. This is the behavioral issue. The mind often prefers a completed win over an uncertain open profit. An unrealized gain can disappear, and that feels uncomfortable. Selling turns that uncertainty into a result. It creates psychological closure. You get to say, "I was right." That can feel like discipline, but sometimes it is just reward-seeking in a more respectable disguise. Why does this happen? Because markets create uncertainty, and uncertainty is mentally expensive. A small profit offers a quick emotional payout. It reduces tension. It avoids the regret of watching gains fade. It can also protect self-image. If you sell low green, you don't have to sit through the possibility that the market proves you early, late, or simply wrong. In that sense, taking profits too early can become less about risk control and more about avoiding discomfort. Imagine two investors own the same asset, and both sell part of it after it rises. Investor A sells because the position has grown beyond the maximum size allowed in the portfolio. That rule was set before the trade, and it applies whether the investor feels confident, nervous, excited, or doubtful. The sale is consistent with a repeatable framework. Investor B sells because the gain feels too good to lose. Nothing important changed in the original thesis. No portfolio rule required action. The investor simply wants to secure the pleasure of being right and avoid the pain of seeing the gain shrink. The outward action is identical. Both sold. But psychologically and strategically, they are not the same decision. One follows a rule. The other follows relief. Now compare the alternatives carefully. Exiting because the thesis changed is responsive to new information. It can be reasonable, but only if the thesis really changed, and this is not just a story invented after the fact to justify an emotional reaction. Trimming because of predefined risk rules is about structure. It can help control concentration, maintain diversification, or keep exposure aligned with the investor's plan. But those rules need to be defined in advance. Otherwise, risk management can become a label used to hide inconsistency. Selling mainly to lock in a good feeling is understandable, but it can weaken a strategy over time if the strategy depends on letting some winners run. Letting winners run means allowing successful positions to stay open long enough for the original idea to develop, rather than cutting them off at the first sign of reward. Not every approach requires that. Time horizon, strategy design, tax treatment in some jurisdictions, liquidity needs, portfolio rules, and market conditions can all matter. So this is not proof that early selling is always harmful. It is a warning that the reason for selling matters. There are also important limitations. Sometimes a small gain really is the prudent exit. Sometimes conviction was low from the start. Sometimes the risk was event-driven or temporary. Sometimes a short-term strategy was never meant to hold longer. And sometimes the long-term impact of selling early is unknowable. You cannot observe the path you did not take with certainty. That is why this is a behavioral explanation, not a universal rule. A useful takeaway is to separate outcome from process. A profitable sale can still be a poor decision if it broke your framework for emotional reasons. And a sale that later looks premature may still have been correct if it followed your actual rules or reflected a real change in the thesis. So before taking a small win, ask 3 questions. Did my original reason for owning this change? Did a predefined rule require me to reduce or exit? Or am I mainly trying to capture the feeling of being right? That pause will not remove uncertainty, but it can improve decision hygiene. And in investing, better decision hygiene often matters more than the temporary comfort of a quick, satisfying win.